Hey everybody, this is Jose Blasco. We are about to start. Can I have a quick sound check, please? A quick message on the chat box would do. This would indicate that you hear my voice, and therefore I would know that we are ready to get started. So please, quick hello in the chat box, quick message in the chat box, just so I know you hear me. Thank you so much, guys. Very good. We just reached the starting time of the session. Wonderful. How are you, Mark? How are you, Gary? Good to see you guys. Let me turn on my camera so you guys can see me as well. How are you? Good to see you all. Welcome to the session. Today is July 12, 2020. Today is Sunday, therefore weekend. Therefore, the markets are closed. And what do we do when that's the case? We do sharpening. Okay, we do sharpening. We spend a little bit of time to talk about the markets, to talk about the skills, to talk about the situations that we may find. We talk about questions and answers, etc., etc. Okay. Sorry for just a little bit of background noise here on my end. Anyway, so let's get started with the session. As I just said, questions and answers are going to be the key topic for today, assuming that you have questions for me. If not, I do have one topic I would like to address, which is out of questions that you guys send in a regular basis via emails most of the times. And we that way we identify a little bit of what is the need of our app subscribers, what is the need of you guys when it comes to utilizing the tools on how to trade. And therefore, the topic I would like to address today is about calibration. I would like to get a little into that topic since I feel that there is the need to discuss calibration, since this is a subject which is, in one hand, very important. In the other hand, most of the questions related to calibration cannot be answered in a simple email like a paragraph. Therefore, this is the one topic I would like to discuss today, but only after you guys ask your questions, if any. If there is no question, then it's fine too. But obviously, I'm here for you guys. While you guys are typing your questions, Miguel, how are you? Good to see you. I will go ahead and read the disclaimer, so that way we'll be able to call the session as officially introduced. So disclaimers: the following videos, clips, demonstrations are for educational and instructional purposes only. Traddictiv provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive on using our products. And that means that now the session is officially introduced and we are ready to begin with our sharpening session. Okay, so I have a TradeStation here ready. I also have TradingView ready. I also have the AutoUFOs user guides for TradingView and for TradeStation ready, so we can talk about calibration, which is the subject I wanted to address. But again, most importantly, I want to take care of your questions. You guys are doing are making the effort of being in the sessions live. So if there is anything you need me to address, any question you may have, anything you would like me to review, even if it's something that we have discussed already in the past before, just know I'm more than happy to do so. So just let me know with a message on the chat box, okay? In the meantime, I'm gonna start getting ready for the subject for today, which is calibration. And the way I'm gonna do that first is I wanna make you aware that in the user guide, this is the user guide for TradeStation. Same happens with the one for TradingView. Right at the beginning here, you already have a paragraph that talks about calibration, okay? With TradingView is the same. So here's the user guide for TradingView, and here is the calibration paragraph. Okay, so calibration is critical. Okay, page 1 of the user guide, we talk about it, right? So it's really critical. And both of the apps, the one with TradingView, AutoUFOs for TradingView, or AutoUFOs for TradeStation, if you fast forward a little bit later in the book, we get to where is it? How to calibrate the app. Okay, so page 11, that will be for the TradingView app. You have how to calibrate the app. With the TradeStation app, we will be dealing with page. One more. Here we go. Settings available. how to calibrate the app. Here we go. So page 15, in the case of a TradeStation user guide, is page 15. Okay. So page 15 with the TradeStation user guide, page 11 with the TradingView user guide, and that's where calibration is. Okay. So first of all, and I see that you guys are not inputting any questions, so then I will jump straight into the matter. So the first thing I would like to discuss about calibration is, why do we even calibrate? That's the first thing I would like to describe, and then I would like to talk about calibration philosophies. What if you calibrate with large values? What if you calibrate with smaller values? What is the outcome? What are the pros? What are the cons? So I would like to discuss this with you from those two angles, so that way you know which calibration settings should you use for yourself. By default, okay, if I install the app, okay, and by the way, one way to utilize the app if you never used it before, it's just to go to the app menu on TradeStation, and you have your trading app store updates, okay. So both for AutoClimate and AutoUFOs, there is a ready-to-use workspace. So if I click on the launch button for AutoUFOs, it will open a special workspace which is already designed with the UFOs in it. Okay, and it doesn't mean you have to use it like that. You can insert AutoUFOs manually. Many of you are utilizing AutoUFOs, so you know exactly what I'm talking about. But again, this is how you get. This is probably the easiest way to get a couple of charts, a matrix, the UFOs in it, ready to go. Right. So that's how you get your ready-to-use workspace. Now, in that ready-to-use workspace, okay, if I double click on the UFOs, okay, and I click yes, do you want to customize the study? Yes. And I get to inputs. Notice how the calibration setting that comes by default is 0.5. This is both if you use the ready-to-use workspace, okay, or even if, let me go ahead and edit studies, and I'm just gonna delete AutoUFOs from here. Okay, so remove. Okay, so if I remove it, and now I want to add it manually, and the way to add it manually is you just go to studies, add study, right? And then you look for the A for auto, and here is your AutoUFOs. So you insert like it's any other indicator, okay? Any other indicator, but you just pick AutoUFOs, and then you click OK, and here are your UFOs. So if I insert like that, and I do the same thing, I'm just gonna double click on the UFO, and I click yes. Do you want to customize the study? Yes. So go back to the inputs tab, and notice how, again, the default parameter for AutoUFOs is 0.5. So why is the default parameter 0.5? Well, it's 0.5 because the range of possible values for calibration is anywhere from 0 all the way to 1. Okay, and 0.5 happens to be exactly in the middle. Okay, so by default, it's coming with a value which is exactly in the middle, 0.5, which is a valid value. To be honest, all values are valid, but they have pros and cons, depending if you're closer to 1 or you're closer to 0 or you're exactly in the middle. Okay, so this is what I want to discuss with you guys, so you understand a bit more about the technology and the impact of calibration in this case. Okay, but let me have a step back, okay? Because what I said is that first I wanted to discuss, why do we even do calibration? Okay. Well, think about it. What the app does is, the app is called UFOs for a reason, isn't it? Probably we all know this, okay? Hopefully we all know this in the group. UFO stands for unfilled orders. So what the app is doing is looking for traces that imply a high probability, a great likelihood for unfilled orders to be available in some price range. Okay. Now, of course, I can make this price range to be, this wide, okay, or I could make this price range to be much less wide, or I could make this price range to be even wider, right? So I can make this to be, super wide like that, right? And so somewhere inside the box there are unfilled orders, and of course the larger I make the box, the more likely I will find unfilled orders in it. If I was to make a box which is the whole chart, then I am very likely to have unfilled orders there. Obviously that would make no sense, of course, But you get my point, right? The larger the box, the more likely you will find on-field orders in there. But also, the larger the box, the greater the distance between what my entry would be and what my stop would be, because normally we want to enter the trade, if you go long, somewhere on the top of the UFO, and you will want to have a stop somewhere below the UFO if you go long. If it was to be a sell UFO, a red UFO, so then it would be the opposite. Okay, it would be red color instead of green, and you will want to get in the bottom, and your stop would be on the top. It doesn't matter if it's green or red. The point is that the distance from entry to stop basically happens to be the depth of the UFO. So if I make the UFO greater, as we said, I increase the probability of finding on-field orders in it. But I also increase the risk of the trade because the distance between entry and stop becomes larger. Where if I was to make my UFOs narrower, then the risk of the trade is less because the distance between entry and stop is lesser, but also the probability of finding significant on-field orders is also less, right? So, calibration, it's an important step when it comes to how the app processes market data, and when it comes to your preferences as a trader, because as a trader, you may prefer to have very wide UFOs, or as a trader, you may prefer to have very narrow UFOs. For example, let's say you are an options trader, and the type of strategies that you love to use are credit spreads, and therefore you are not having a bet on the directional movement of a stock. You are having a bet on a price point where the stock is not likely to reach that price point from now until an expiration date. And therefore, you want to create a lot of space between the current price and the stopping price and the stopping point, precisely because your bet is not where the stock may end up traveling to. Your bet is more about the stock not reaching a price point from now until an expiration date. So a trader doing that kind of strategy may prefer to have wide UFOs, where a trader which is doing directional trading may prefer to have narrower UFOs. So you can go with a larger size, and if you're right, you make more, and if you're wrong, you lose whatever you want. But you get to find out very quickly that you lost because the distance between entry and stop is close by. That making sense? So again, this has to do with putting on the side the processing that the app does. It has a lot to do with the trader personality, with the trader style. Is the trader conservative? Is the trader risk averse? It has a lot to do with all of that. Okay, and those basically are the reasons why there is a function for calibration. So you can take the app and kind of customize it to your liking given your trading style. While you are doing that, the app is plotting an inner circle within the circle. So the app, it's also kind of ignoring what your choice when it comes to calibration is, and pointing with the inner circle where the greatest concentration of on-field orders should be found based on the app. But also, depending on the calibration setting, you are giving more or less importance to the remaining portion of the UFO, what we call the UFO band that goes from the top to the bottom. And that's what you are making wider or narrower when you are adjusting those calibration settings, again, to adapt to the trader liking, to the trader style, being directional, non-directional, conservative, non-conservative, etc., etc. Okay? So now, let me take a look at your questions before I keep going. Jaime, can you explain better if I have an account of 1K to invest in futures, how can we open positions? Okay, I'll take a look at that in a minute. Mark, suppose one had a 30K account for options one day, the percentage of the account. Okay, I'll take a look at your question in a minute because it's not related to calibration since I am already in the subject. Okay, but I'll come back to you, Jaime and Mark, both. Sukma, warm greetings and prosperous greetings. Welcome back, Mr. Jose Blasco. Thank you so much. I'm always faithful to listen to your material. Hopefully, will always be facilitated in learning and encouragement. Absolutely. Thank you so much for those words. That means a lot. Jaime, like if we can open like 0.5 contracts in less. Okay, coming back to you, Jaime, with those questions. Very good questions. Let me complete the conversation on calibration since I already started, and then I'll go back to you. Thank you for typing it. And everyone else, if you have questions, just type it in, even if it's not related to calibration. I'll take a look, and then I'll come back to you, okay? So I'll make sure that all questions are answered before the end of the session, okay? Cool. So again, my first point was, why do we even calibrate? Okay, and hopefully now you are with me on why calibration exists, and the importance of adapting the app to your trading style, to your trading methods, directional, non-directional trading, selling premium, going long and short, futures contracts or stocks, all of those different possibilities. Of course, calibration is one of the tools to adapt to you depending on what you trade and your style. Okay, so this is one first conversation I wanted to have with you. Second part of the conversation is, okay, now that you know what type of trader you are, now that you know which markets you trade, now that you know your style, etc., etc. So which calibration setting should you use? What's the ideal calibration setting for you? Okay, and again, by default, as I've seen and I've shown earlier, remember the app comes with a setting of 0.5. Okay, so what does that mean? Does it mean that you should use 0.5? Well, maybe yes or maybe not, right? So as I said, the range of possibilities for calibration goes from 0 to 1. 0.5 being in the middle certainly makes it a valid setting. To be honest, all settings are valid. 0.2 is valid, 0.8 is valid. So all settings are valid. What is key is that you understand the pros and the cons of the settings. And while you understand the pros of the cons and of the settings, then I want to show you the right process on how to calibrate and get reported data that confirms that what you're looking for is what your calibration produces. Okay, so that way you think about it from what you want to achieve, you change the settings, and then you confirm those settings produce what you want to achieve. That's the idea. Okay, knowing that all values are valid, because again, it's like if I was to ask you, what's better in trading? Is it better to be conservative or is it better to be aggressive? I don't have an answer, because the answer really is it depends. There will be months where an aggressive trader would make more money than a conservative trader, and there will be months where a conservative trader will make more money than an aggressive trader, because it depends on the market conditions, it depends on the trading method, it depends on the time frames used, it depends on the level of volatility of that month, it depends on many things. So there is no right or wrong, okay? And in trading, it's all about, it's not about right or wrong in trading. In trading, it's all about, number one, probabilities, number two, understanding the pros and the cons of whatever decisions you have for your trades. So if the decisions that you have for your trades imply that when the market is very volatile, you're going to do very well, so then you will do very well when the market is volatile. But when the market is not volatile, the same methodology may just be so-so, okay? Which it's okay. There is no methodology that works at its peak all the time, because market conditions are dynamic and keep changing. So it's important, and because we don't know the future, so you don't know tomorrow what type of condition you will have. You can only react to it. And let's say your methodology works very well in volatile conditions, and let's say the next month is going to be volatile 3 days only, and all the other days are going to be quite boring. So then next month you are likely to not to do too well, even though your methodology is valid, right? And then maybe next month market conditions change and become volatile almost every single day, and now you're just going to kill it, right? So again, it's all about pros and cons paired with the probabilities of your method or your tools. And the two things together is what gets you to a certain point. Now, on top of all of these, which I just said, there is another aspect which is absolutely critical, and believe it or not, is directly related to calibration, which is the emotional impact of trading. Trading is an emotional game, big time, really, really big time. Okay, some market experts would agree by stating that trading is 90% psychology. I don't know if it's 90% or 80% or 75%. I have no idea. I'm not a psychologist, but it's a large percentage. You may have the best methodology in the world, the best apps in the world, the best everything. If you get emotional in trading and you don't manage your emotions, you're going to get in trouble. So calibration has another impact, because calibration is going to make your plotting of the UFOs to be more, as I said, aggressive or conservative. So now you have an opportunity to adjust the app to your personality. And if the app is adjusted to your personality, the probability or the likelihood of you getting emotional is less. Think about this. Let's say you have a calibration setting which makes the app to produce many UFOs. So if you have many UFOs on the screen, you're going to trade very often. But let's say you were to be a very conservative trader. And let's say your goal is to take one trade per week. You know, you want to be let's call it a relaxed trader, slow pace, one trade a week, very conservative guy, but you have a calibration setting that implies many UFOs new every day, many opportunities in front of you every week. So what's going to happen? You're going to trade more than what your psychology suggests you should. And then you are opening the door to overtrade and be more emotional than what you should. And it's not like you don't know who you are as a trader. You know you're a conservative guy, but if you're a conservative guy and you use the wrong calibration setting, and the calibration setting is getting you to trade too often, then you open the door to emotional impacts, which may get you making many mistakes and lose money or not to profit the way you should, because again, you are affected by the emotions because your calibration settings are getting you to trade too much. So if you think about it, it's all related. Being conservative or not, your trading style, the product that you trade, your trading psychology, all of those things, I touch on it. And basically, the trader in you, given all of those different factors, should imply a specific calibration setting, which could be different compared to another trader. And that's what I said. All calibration settings are valid, anywhere from 0 to 1. All calibration settings are valid as long as you make sure that the calibration setting you use for your trading is adapted to you. And to do that, you first need to know who you are as a trader. Number 2, go through a process of calibration, which I want to demonstrate now. And third, what you want to do is to do some back testing or forward testing that this particular calibration setting, when you apply it to real-time market conditions, produce what you want, and you are comfortable with that particular type of calibration, this quantity of UFOs on the charts, etc., and therefore, that's exactly the type of tool you need, and you are comfortable as a trader producing what you need without getting emotional, etc. Okay, so again, all values are fine. In a perfect world, you would put some time and effort to find out which one is the best for you. By default, it comes with 0.5 because, of course, we need to have some value to get started, right? So 0.5 seems to be in the middle, so let's call it valid. But again, I would certainly, like it's clearly written in the user guide, I would certainly point at the fact that calibration is critical because it basically impacts how the analysis is carried out, and therefore the output produced by AutoUFOs is going to be different. So make sure you spend a little bit of time doing some calibration exercises as I am about to demonstrate. Okay? Mark, so the center nucleus stays the same no matter the calibration setting, correct? Not exactly, Mark. Not exactly. It's a bit complicated to explain because the app is processing a lot of market data. So there may be instances of cases where you change the calibration setting and the nucleus stays in the same place, but there may be other market instances where there may be slight variations, okay? Most of the times it should stay the same, but there may be times where it's not the case. And basically that depends on multiple parameters, especially when it comes to the liquidity of some markets that you trade and things like that. Again, the app is processing a lot of data behind the scenes. What we see on a chart really is it's 4 pieces of data, isn't it? For each candle, you see the up and the close, the high and the low, right? So 4 pieces of data, but the app processes much more data than that, isn't it? So the app could be processing data such as volume per candle, ticks per candle, up volume per candle, down volume per candle, up ticks per candle, down ticks per candle, process ratios such as how much movement, what is the range of the candle given the volume that was given, how much is the range of the candle given the up volume, given the down volume. So again, there is so much data which is being processed that the eye cannot see. Again, there may be slight variations to the nucleus as well, as you call it yourself, isn't it? I love that term, by the way, Mark. It's a very smart one. So now, if you call it nucleus, maybe we should change the name to the app. the name for the app instead of AutoUFOs or Auto Atoms, maybe. But anyway, I love your approach with your term there with nucleus. I like that. Again, most of the times, going back to Sirius, most of the time you should see the nucleus in the same location. There will be times where it's not exactly the same case, okay? So again, good. So having said all of that, let's go back to a fresh chart here, okay? And I'm gonna maximize a chart. I'm gonna use the white background as well because I think it's neater when it comes to sharing my screen. It's a bit more lively. Also, in this chart, on purpose, I got all my candles to be grayed out. So the only thing that is colored is gonna be the UFOs, either green or red. So the focus is what we need, which is the UFOs. The candles, it's field orders, right? The UFOs is on field orders, which is the focus, right? So that's why I got all my candles grayed out. Nothing wrong with keeping the color in the candles, but I just want to make sure that you guys have the focus on what is needed, okay? So in this case, I have a chart, which is the 55-minute time frame of the S&P. And this is just the starting point. By the way, this is, let me show you my calibration, okay? My calibration here, as you can see, you may have seen this in prior sessions, is 0.618, okay? This is my calibration. It doesn't mean it has to be yours. It is mine, okay? And if you want to use it, you are more than welcome to. But again, don't do it just because I do it. Just make sure that if you're going to do it, you do some exercises yourself to confirm that this makes you happy, given the trader in you and your trading styles and methods. Does that make sense? So now, in this particular case, when I load the 55-minute time frame of the S&P 500 futures, the @ES, I get green UFOs, okay? It doesn't seem that I have red UFOs, okay? Even if I move the chart down, okay? And if I was to load a monthly time frame, okay, you would see that, you know, the highest trading price ever in the S&P took place in September, I'm not sure why I said September, in February, right? So if I was to go back to 55-minute time frame, okay, if I was to go back to 55-minute time frame and I was to load data all the way to February 2020, okay, first date, February 2020, and I click OK, and I was to scroll down, you would realize that, you know, now a few UFOs have showed up on top, okay? So in other words, when you load a chart and you are about to do calibration, you want to make sure you have green and red UFOs. So you can calibrate for both the buy and the sell opportunities. Certainly, there are times where certain markets are making all-time high. And when a market is making all-time high or making all-time low, you will only have green UFOs or you will only have red UFOs. And if that's the case, well, you can still do calibration, okay? You can still do calibration, but really, I would recommend that you have green and red UFOs on your chart, so that way your calibration is more balanced. And the reason why I am suggesting to do so is because notice that I am linking calibration to your trading style, to the trader in you. That is not likely going to change anytime soon because you are you, and while you will grow as a trader, your personality will tend to remain the same. Or if you change your trading personality, it may take, you know, a couple of years, 5 years for you to really change as a trader, because if you are conservative, you are conservative, no matter how experienced you are. So probably, you know, that's not going to change too often, right? So my approach to calibration and the way I'm leading you to calibrate the app in this case is that, you know, load data where you have red UFOs and green UFOs. So you can adjust the calibration for all type of scenarios, sell orders, buy orders. And once you get to that point, then that's your calibration setting, and you don't need to bother and recalibrate every week, recalibrate every month, recalibrate every year. That's your calibration setting, and you leave it like that. Let's call it forever, okay? I mean, forever, maybe it's too strong as a statement, because again, you will change as a trader, but it's not going to happen too often, right? So you don't need to calibrate every week, every month, every year. You know, this is something that you do, you know, very, very, you know, very, very rarely, okay? My calibration setting is 0.618 for years and years and years, and I don't plan to change it. Okay, to be honest. Okay, why? Because it represents the trader in me. Okay, so maybe at the very beginning I was using a different setting, then I have evolved as a trader. I've been trading for over a decade, so I don't think the trader in me will really change much more. When it comes to my personality, the trader in me is who I am now, okay? And that's it. So my calibration setting will be like that forever. If you are newer to trading, well, I would say maybe you want to review your calibration parameters, maybe let's say once a year, okay? But no need to do it once a month or once a week, okay? So don't think about calibration like something you have to do for every market and you have to do it every day. It's not like that. Because again, the app is already doing an intelligent processing behind the scenes. The calibration setting is to adapt that process to the trader in you. It's not to fine-tune the results. When calibrating the app, and this is written in the user guide, by the way, basically you have to work on changing the inputs, okay, which is your calibration input, but also, especially if you do it on TradeStation has the UFO stat feature, which is not available on TradingView, but you have it available on TradeStation. And when you turn on the UFO stats feature, you basically get that blue value with a percentage, okay, with a percentage. Now, very careful here. That percentage has nothing to do with probability of profit or rate of return in a month, in a year, has nothing to do with that. This measurement, okay, what this value represents is, I'll write it down, how often, okay, price travels from UFO to UFO. That's what that means. In other words, when a market hits a green UFO, okay, the question is how often it turns and keep traveling until it hits the red UFO above, okay, and vice versa, okay, and vice versa. In other words, if the market hits a red UFO, how often it turns and keeps traveling, I just forgot an S there, sorry for that one, and keeps traveling until it hits the rival green UFO below instead of above, right? So when price enters a UFO, how often it happens that it turns and travels all the way until the rival UFO, okay, to the upside, vice versa to the downside. When price hits a red UFO, how often it happens that it turns and drops until it finds the rival green UFO. So how often price travels from UFO to UFO, this is what this percentage measures. For sure, if you take all those trades and you see a number which is greater than 50%, so you are likely to make some money there, right? Because it's probability. Now, of course, some UFOs are larger than others, so you will need to adjust the trade size to be the same for all trades. Also, what about the drawdown in your account? So what if the market is violently changing climate, and next thing you know, even though you have 61% probability in this particular case, what if you were, for example, what if there is a very violent change of climate and you have 3 UFOs lining up on top of each other like that, and price just goes through? So now you just got 4 losses in a row because there was a change of climate. So should you take all those trades with the change of climate? Of course not, as a trader. But again, that's a good reference to tell you about efficiency. Trading has more to do. Let me rephrase that. Trading has more for us to do as a trader than simply taking every single trade just because there is a UFO, isn't it? We adjust the size of the trades. We use stops in a specific location. We look at the climate and we don't fight the climate. We trade in the direction of the climate as long as the sustainability stats for the auto climate are still giving us a go ahead to do the trade. So in other words, many of those UFO trades are to be ignored. But if you end up with a number which is 50% or better, you know you have a statistical edge in this trade. Is that making sense? Now, while you have a statistical edge in trading, even if you were to ignore everything, right? While you have a statistical edge in this particular case with 61%, changing the calibration not only will change that number. Okay, take a look. So I'm going to move from 61.8 to 0.80. Okay, so let's see what's going to happen to that number. But also, let's see what's going to happen to the UFOs. Okay, so let's take a look. 1, 2, 3. Okay. So with the same amount of data, I got a better figure. So the higher the calibration setting, it seemed that it helped to improve the UFO performance stats, which is good. But what happened to the amount of UFOs available on the screen? Well, I got less UFOs on the screen while the probability is better. Right? And now let's do the opposite. What if instead of going to a 0.8 probability, I was to go to let's say a 0.4 probability, 0.40. Okay, so let's see what's going to happen. So when I do that, notice how I have so many more UFOs now. But what did just happen to the probabilities? They went down. So let's go back to the beginning conversation. The initial conversation we had was calibration is to adapt to the trader profile, right? So let's say you are an aggressive trader, an active trader, a trader who doesn't want to stop trading and wants to trade as much as possible as long as it meets the plan, right? Well, 53 is more than 50%. So you still have a statistical edge. And of course, your methodology will use many other things, right? So you may use the climate, you may use FIPS, you may use Bollinger Bands, you may use whatever you use, okay? Maybe you are a purist trader and you use exactly the methodology I use on the channel. Maybe you use other methodologies and you add UFOs as an odds enhancer, or maybe you use UFOs and you use other tools as a tool that helps you to increase odds even more. So again, everybody trades differently. It's all good, right? Well, if you were to be that trader, 53% gives you an edge because it's more than 50%. On top of that, you got many UFOs. So if you want to be active, it's ideal because you have many opportunities for you to execute. Okay? Now, what if you were to be on the other extreme, which is you are very conservative, okay, and you want to execute only a few trades, and because you are conservative, you want more than 53, so now you go for 0.8, and now notice how you have 64%, which is much better than 53%, but now notice how we got less UFOs on the screen, okay, and therefore, basically the app is giving you the best UFOs only, and they are less, and that's why the probability is more, because it's the best UFOs only. Is that making sense? Also, those UFOs, if you notice, there is another aspect, which is they are a bit wider. Okay, they're a bit wider. So again, if you are not only conservative, but you are also, we talked about credit traders selling options, instead of being purely directional, they are expecting price not to reach a certain price point before an expiration date. So, you want to give yourself room in the chart, and now those UFOs are a little fatter, if you wish, isn't it? So what's right, what's wrong? They are both right. 64, 53, more UFOs, less UFOs, all of it has pros and cons. So it's all about adapting this to your trading style and your priorities and preferences in trading, given the trader in you, which has a lot to do with your trading personality. Okay, so again, by default, out of curiosity, let's input 0.5. Okay, so by default, 0.5 will produce 56% and many UFOs. Okay, I use 0.618. Okay, and I get a bit better probability, a few less UFOs. Okay, but still many. So that's me. Okay, if that matches with you, go ahead and use 0.618, but make sure you also do some practice, some backtesting, so you know what you got in your hands. Okay, because calibration in the end it's a pretty big responsibility, and it's your responsibility as a trader to make sure you have the right calibration given the trader in you. Is that making sense? But hopefully this exercise is helping you to see the impact, the differences, the subtle, um, how do I put it, the subtle effect that changing calibration has on the amount of UFOs and the type of UFOs that you have on the screen, and therefore you could better understand what the right calibration setting would be for you in your case. Okay. Now, I'd like to get some confirmation, if that's okay, that you guys are following this conversation up to this point, because I want to add something else, but I don't want to do it unless I get a bit of confirmation from you guys when it comes to what everything I have explained up to this point. And guys, feel free to ask questions because this is quite critical, to be honest, especially because again, once you decide your calibration settings, that's it. That's your calibration setting. So you better make sure you do it right. Is that making sense? And again, if you don't know where to start with 0.5 is the default. But of course, from there, going to back testing and finding out your expectation in trading, so you know what you got in your hands. Okay. Good. So it seems that you guys are okay. Wonderful. Now, a minute ago, I was looking at this chart with 1,597 bars in it. Okay, and when I did that, I didn't have the right UFOs. Remember, I had to load data all the way to February 1st, 2020 to get those red UFOs. So now I can calibrate, in a way where I know this is incorporating both the buy and the sell side in my calibration, which is a more complete way on how to do it. Okay. But what if you are dealing with a market? Okay, so let's go back in time and let's pretend that today, I'm going to use 1,587 bars, and let's pretend today it's February 1st, 2020. Okay, let's pretend that's the case. And therefore, we are in a stage in the market where we are basically making all times high. Okay, we just need a second here for the chart to load. I'll take a sip, guys, if you don't mind. Thank you for that. Perfect timing. Well, actually, on that particular date, we did have a few UFOs. So let's go back to January 22nd. Okay, so let's say it's January 22nd, 2020. Okay, I got all my bars loaded. Okay, and when you are about to do calibration, basically, you could do it, but there is only one red UFO, and it doesn't matter how much data to load, you are not gonna get more UFOs that are red colored UFOs because there is nothing above price, because the market is making all times high right there, right? So there is no more. So how can you do calibration? Well, one way to do calibration is to go back in time and calibrate data from the past, check what the results are, and then go to the present to check what the results are in the present. And they should be similar. They should be about the same. If they are not about the same, I would strongly recommend not to trade that market. Okay, because that would mean that the market participants in that market have changed in a major way. Okay, so for example, let's take a look at, instead of January 22nd, 2020, okay, let's go back 1 year in time. I'm just gonna go back to 2019, January 22nd, 2019. It's gonna take a little bit of time for the chart to load. We're just gonna wait patiently. Okay, so again, I am pretending it's January 22nd, 2020. We're making all times high. There is no red UFOs. I cannot calibrate. So what do? Go back in time. Could be 1 month, could be 1 year, could be 10 years, whatever you want. Okay, and you calibrate the app. Okay, and let's say after I calibrated the app, I got 64%. Okay, so 1 year before, with my setting of 0.618, I got 64%. Okay, you may conclude that you did the exercises. You were moving around. You did 0.3, 0.4, 0.5, 0.6, 0.7, 0.8. You were just testing how many UFOs you get, what are the UFO performance stats, and you concluded that given your trading personality, you are going to use 0.45, 0.63, 0.71, whatever you concluded. In my case, 0.618, and I got 64.33%. So once you do that, here's what I would suggest to do to make sure that your calibration it's stable. Okay, so what I would do is, again, double click on the candles to get access again to my last date table. Okay, and what I would do is go move 1 month at a time. Okay, and make a note. Okay, so I'm just gonna go ahead and do this on a spreadsheet, because again, spreadsheets are very convenient to do numeric stuff, isn't it? So here is the January. Okay, so I'm just gonna go ahead and do from January to January. Okay, here we go. We got 64.33. That's what we got. Okay, in the first January. So now what I'm gonna do is I'm just gonna move to February. Okay, February 22nd, 2020. Still loading the same amount of candles, 1,597. I'm just moving 1 month later. Okay, so data is loading, and it's gonna show in a minute. Okay, and now it's 57.79. Okay, so 57.79. Okay, and then I'm moving to March. So March 22nd, 2019. And now I got 59.27. Okay, and then we're gonna move to April. And again, all of these things take time, but also it really helps for you to internalize and confirm that the calibration settings that you have selected make sense to you. Is that making sense? So it's worth it to do it, especially because you do this and you keep that setting, for, let's call it for life, okay, or at least for a year, right? So 59.93. Okay, so this is April. Then we go for May. So May. So we're waiting for May. That's 58.55. 58.55. Then we move to June. Okay, so bear with me on this, guys. I know it's probably not the most exciting lesson we ever had, but it's certainly very impactful and important. Okay, so it's important that you guys get this. So 60.47. I'm gonna move to July, and July is giving me 55.90. And then I'm moving to August. And then with August, what do we get? We get 62.21. And then we are moving to September. September is 64.76. Then we are moving to October. We're almost there, guys. Just a few more months and we got it. So October is loading. That's 57.88. Okay. In November, that's 59.53. Right. Then we got December. That's 62.76. And then finally, we got January 2020, which is 60.80. Okay. Now, if I take this set of data and actually, I wanted to do an average, okay? And I do an average, okay, not like that. So I wanted to do an average, okay, of all of these. I come up with 60.32. It's kind of, a pretty normal thing, okay? 60.32, it's a pretty normal thing. And something that you can do as well, again, this is not an Excel course or anything like that, but under formula, okay, there is lots of formulas that have to do with stats, okay? So statistical formulas, okay? And one thing you could do is you could calculate, okay, a standard deviation Okay, and there are different types of standard deviations, and again, I don't want to get into these. Okay, but anyway, so I'm gonna use this one. Okay, so if I calculate a standard deviation, okay, and I do it for all those values, okay, so it's telling me 2.62 is a one standard deviation of that, of the set of values we have. In other words, a normal thing to happen for a reasonable thing to happen for the stats is to be ranging between 60.32 plus 262, or ranging between 60.32 minus 262. In other words, any values returned by AutoUFOs which give you statistics between 6294 and 5770 are to be accepted. Okay, are to be accepted. So if you ever load, like let's say for example, let's load the current date, right? So let's go back to the current date, today, right? And today is giving you 6163, 6166. Well, is that value between that range? Even though that's, few months later, right? Few months later, the set of data we got. Is it between? Yes, it is. So then, does it mean that the nature of that market has changed, or the nature of that market is still the same? Well, it's still the same. And by the way, it's the S&P. So I'm not surprised about that. With stocks, it changes a lot, okay? Because stocks, given market cycles, sector rotation, you may have stocks that have a lot of institutional interest, and next thing you know, they lose institutional interest, and they used to have good performance stats, and then they become very weak. Okay, so this could happen with the S&P. I mean, I would be quite shocked if that was the case, but it could happen, right? It could happen. So, doing this type of exercise, it's very healthy, because now you know what you got in your hands, and there is a key word in trading, which is the word confidence. Okay, and confidence, of course, we cannot be a good trader unless we trust what we do, including ourselves. Okay, and confidence comes through experience comes through practice comes through time. So it takes time to develop confidence, but there is another aspect of confidence, which again has a lot to do with the trader in you, which is the day when you start trading a new market that you never traded before. So let's say you've been trading the S&P for a long time, and you know everything about the S&P, you are comfortable, you are consistently profitable with the S&P, everything is good with the S&P, and now today you just decided, you know what, I think I'm going to start trading the crude oil, right? And you come to crude oil, okay, and you did a calibration setting, and let's say you come up with, okay, I'm going to use the same values for crude oil, which that's ideal. You want to use a calibration setting which is the same for all the markets you trade, because again, the calibration setting refers to the trader in you. Is that making sense? So now what happens to the crude oil? Well, with the crude oil, I'm getting 61.17. Okay. And what I was used to trade before was markets that would give me UFO stats between 62.94 and 57.70. The last month it was 61 point something. And guess what? Crude oil is giving me 61 point something. So even though I have never traded crude oil, in a case like this, do you think I would feel confident trading crude oil? Or I would feel like, oh my God, I better don't touch this market. Who knows what's going to happen here, right? Is it a similar UFO performance stat, or is it very different? Because it's not always going to be the case, okay? So if I show you, let's look at corn, for example. Okay, so I'm loading corn. It's going to take a little bit of time. So pending data on the upper left. What do we get here? 60 point something. Similar market. Looking good, right? You never traded corn before, so what? What to expect from corn? It's probably similar to what you would expect from trading the S&P or the crude oil from a statistical point of view, isn't it? Orlando, good to see you, my friend. Good that you joined us today. Wonderful. So again, let's say you have never traded copper and you want to trade copper. Okay, so now you turn on the UFO performance stats, okay, and we are waiting for the pending data to be loaded, and then you get 58%. Okay, so now is that 58% between 57 and 62? Yes, it is. So would you expect your outcome or your experience trading copper to be that much different compared to the S&P, or should it be something more or less similar? Well, of course, it's a different market, different nature. But when it comes to on-field orders, you are getting reasonable stats that should open the door for your confidence level to be there to at least start paper trading that market, collecting a set of samples and be able to analyze these samples and these results and come up with an expectation measurement to know what to expect from copper. Okay. Now, what if you were to load a market you never traded before and your stats happen to be 0.3, okay, or 30%? I meant to say. So probably you're gonna be like, wow, I cannot trade this market, or maybe for that market I need to come up with a totally different calibration setting, right? So again, it's important to run calibration to adapt the way the app runs the process to the trader in you. So you have either more UFOs in each chart or less UFOs, and they are either wider or narrower. This also impacts the probabilities, of course. So it's all tied up. Okay. So to adapt the app to the trader in you is important to do the right calibration. But then it also has a very important effect. Earlier I mentioned trading psychology and the management of your emotions, but now here, we are certainly talking about trading psychology, but now trading psychology in the form of your confidence level. Like, okay, you're about to trade a market you never traded before. Do you even start or you don't start, right? Let's say you never traded the euro. Okay, I never traded the euro. Should I trade the euro? Or maybe I traded the euro, but I never traded the euro yen. Okay, so let's take a look at the euro yen. Okay, pending data. So waiting. 1, 2, 3. Here we go. 54.86. Okay, is it between 57 and 62? No, it's below. So maybe you're like, you know what? I'm not going to trade the euro yen. Okay, maybe the institutional interest in this time frame is not enough. Or maybe for you to trade the euro yen, you need to concentrate on larger time frames. Okay, and maybe you're going to trade the 233-minute time frame on the euro yen. Let's see what happens in this particular case. Okay, 1, 2, 3. Okay. Oh, no, okay, that's not enough candles. Let me load 1,597. Here we go. So pending data, almost there. So what do we have with the 233-minute time frame? We're going to see that in just a second. Orlando, it's a pleasure to have you, my friend. Pleasure to have you. We missed you. We missed you many times, actually. I don't mean to make you feel bad. I know you are very busy. But we do miss you. So notice what happens here. With the euro yen, you have 52% if you use the 233. So common beliefs out there in the world is that the larger the time frame, the more relevant. Well, not for every market. Maybe for the euro yen, the best thing you could do is maybe what about if we trade the 21-minute time frame? So if we use 1,597 bars on the 21-minute time frame, what happens here? Well, now you got 63% probability. Okay, and that makes you happy. So now, what's the beauty of calibration? Killing many birds in one stone, which is first and most importantly, adapt the UFOs to you, the trader in you, your personality. Number two, gives you a easier time managing your own emotions, as well as building confidence when it comes to trading markets you never traded before. So before you start the back test, the paper trading, the forward trading, you know what to expect. Okay, building that confidence. Okay, and third, okay, identifying where the institutional interest is. Sometimes you would expect a lot of institutional interest in one place, and it's not. You would expect more institutional interest in a 233-minute time frame on the euro yen. Actually, there is more on the 21-minute time frame. Okay, so you can find that. Or, for example, stocks. Let's say I'm going to trade the 55-minute time frame of Microsoft. Okay. So I'm looking at Microsoft. Okay. It has a UFO performance stat of 50%. By the way, with stocks, it will always be lower because stocks only trade 6.5 hours a day. So many orders are canceled many times. Okay. So performance stats will always be less. Okay. But what with stocks, precisely because they only trade 6.5 hours a day, what if I switch to pre and post market? You would probably say pre and post market is going to be worse because there is less liquidity, less people trade. Well, take a look at what happened with Microsoft. You got greater UFO performance stats when you turn on pre and post market data. okay? And you got less performance stats when you use regular session data, okay? It's not always like that. It's not always like that. I'm just improvising Johnson & Johnson. I don't remember by heart because it's thousands of stocks literally in the US market, so I don't remember all by heart. But let's take a look at Johnson & Johnson and see what happens, because sometimes it's the opposite. Sometimes you got better performance stats during regular session and worse during pre and post market. And sometimes you just don't have good stats at all. So with Johnson & Johnson, with regular data, okay, regular session data, you got 55%. With pre and post market, you get 52%, which is worse. So this is the opposite of Microsoft. With Microsoft, we got more quality data, more reliable data based on pre and post market data, and worse based on regular session data. With Johnson & Johnson is the opposite, okay? And then there are other stocks. Let's check McDonald's, for example. Hello, Julius. Good to see you. Wonderful that you're joining us. So loading McDonald's here. And what do we get here? Well, with McDonald's, we get 45%, which basically is telling you that there is limited institutional interest. Remember, below 50%, you don't have an edge, okay? And what does that mean? It means that the majority of the on-field orders that are placed in the marketplace, they get canceled if they don't get filled soon enough. So you don't have a statistical advantage, okay? So it's better to not to trade McDonald's, directionally speaking, and if any, maybe come up with a complex options play where you can offset this problem by using options where certain option strategies have advantages, isn't it? But if you were just to buy shares and hope for the best, given those UFOs, well, you now realize those UFOs are not so reliable. In the case of McDonald's, where in the case of Microsoft or Johnson & Johnson, they were reliable. By the way, then with sector rotation, who knows, 3 months from now, Johnson & Johnson may give you 45% and McDonald's may give you 65%. We never know, right? So again, the calibration process when it comes to the UFOs is something that you do very few times. Okay, in my case, now it's a lifelong thing. So my calibration setting, I don't plan to change it ever. But looking at the stats, especially when it comes to stocks or new markets that you never traded before, it's something that is useful to check, and you may even want to leave the setting when it comes to show UFO performance stats. Okay, that setting, show UFO stats, you may want to leave it as true all the time, so you get this figure on the chart all the time. So you take a quick look every time you're about to trade, because sometimes the nature of some markets change. Now, of course, if you trade very liquid markets such as the S&P, crude oil, etc., the nature of those markets are not likely to change overnight. Okay, if any, it's going to take years for this to change. But stocks, especially, they can be markets that are very sensitive to changes. Okay. Anyway, so this is all I have for you when it comes to calibration. There are a few questions in the chat which I want to address, of course. But before I do, I'll take a sip of water. And in the meantime, I'd love if you guys could confirm that you are with me with today's subject, today's presentation, and everybody's clear on calibration and the importance of calibration and the fact that you need to put a little bit of time and effort and play with the charts until you find the calibration settings that make sense to you, and then you backtest to make sure that the expected results is what you get. So everybody with me on that, please give me a confirmation on the chat box, and I'll take a sip. Thanks for that. Very good. Very nice. Cool. Very nice. Okay. So now, change of topic. Jaime. So Jaime said, can you explain better, if I have an account of 1K to invest in futures, how can we open positions with contracts applied to our account size? So the first thing I would say to you, Jaime, is that $1,000, it's very tight in order to be able to trade futures properly. The good news, though, is that since some time ago, and actually they became quite liquid, especially the CME, other exchanges too, but the most important one is the CME, has released what is known as micro E-mini contracts, and those could be traded with less capital, and it could be a good beginning for you developing yourself as a futures trader. Okay, so let me show you a couple of things. I'm just loading a website on my other computer screen and moving the browser to this screen. So I got into a TradeStation.com website here. Okay, and it could be any other broker. You can even look at it directly on the website of the exchange itself. You can look at cmegroup.com and you will get the same information. But I like very much how it is done in here, because you just go into this menu, pricing, and under you have futures, margin, rates, and just with one click you're gonna get a table that basically answers all your questions, Jaime, when it comes to the amount of capital needed to trade futures. Okay, so take a look. When I scroll down here, you have on the left the markets, okay, which could be indices, okay, could be currencies, could be interest rates, right? So we have interest rates, we have metals, we have energies, right? So you have basically all the futures markets, agricultural, meat, softs, other. So you have all the key markets. Now, many of those markets are not liquid, so we don't trade them, but they do exist for the hedgers and the commercial players, isn't it? So they are there. And, you know, that's what we got on the column on the left. And then the columns on the right, okay, they show you the symbol root, the initial margin, the maintenance margin, and the day trading rate, okay? And basically, the two columns that are key for you, it's the initial margin and the day trading rate, okay? Maintenance margin, even though it's important, it's always less than initial margin. So 12,000 is less than 13,000, 15,000 is less than 16,000, 6,000 is less than 7,000. So just to be pessimistic, let's focus on the initial margin, which is the greatest of the values, okay? Now, sometimes for day trading, there is a reduction. For example, in the case of the S&P, okay, for you to trade intraday, you only need 25% of that, okay, per contract, okay? For each contract, you need 25% of that for you to be allowed to trade. So if I get a calculator on the screen, okay, 13,200 times 25%, 13,200 times 25%, that is $3,300. This is the amount of money you need to be allowed to execute one trade with one contract, either long or short. If you don't have that capital, you will get a rejected order message on the platform, and the message will be insufficient funds. Okay, you need at least 3,300 to be able to take this trade. 1,000 is not enough. Okay, and this, by the way, this is for day trading. If you were to hold the trade past the closing time, 5 p.m. New York time, then you need $13,000 in the account. If not, you get a margin call. Okay, so again, you know, this is to be understood and certainly to be respected. Okay, now what's the beauty? Most of the indices. Okay, so you have the S&P, you have the Nasdaq, you have the Dow, you have the Russell. Okay, those are the four most important markets. Okay, the ES, the NQ, the RTY, and the YM, and they have their corresponding micro E-mini version. Okay, micro E-mini. And notice how the quantity of capital required is basically 10 times less, because the amount of money you make or lose with the micro E-minis is 10 times less per contract. So the capital required is 10 times less. In other words, instead of 3,300, you need 10 times less, which is 330 per contract to either go long or short. So in other words, with an account of $1,000, basically you would be limited to trade micro E-minis. Okay, so if you are starting with 1,000 because you want to be careful and you want to start small, then use micros. You could certainly practice larger size on a simulated account while you practice real trading with the micros. And when you see results in the simulated account and you see results on the real account with the micros, well, maybe that's a good motivation to add more money to your account and then trade the regular size, the e-mini size of these products instead of trade the micro. Okay, that's how you would do it. Okay. Also, Jaime says, like, if we can open like 0.5 contracts, you cannot. The minimum to trade is one contract. 0.5 contracts cannot be traded. In Forex, you can trade 0.5 lots in spot Forex, but this is a decentralized market with decentralized products. So Forex gives you a lot of flexibility because of that. In the case of futures, you are trading a centralized product. It's all regulated by the exchange. You cannot trade fractions of a contract. The minimum is one. So if one is too much, the route would be to trade micro minis. Okay, and basically those are your four guys. You also have micro gold, and you also have the micro euro. So okay, you have it here. Okay, so you have the euro currency. Okay, and then you have the e micro euro. Okay, and then you have gold. Okay, you have gold, and then you have the micro gold. Okay, that's it. All the other micros are not liquid. Okay, so you have the four indices, the euro and the gold. You have the micro version, which is okay to trade and liquidity is fair. So that's how you do it. Jaime, if you have any question about what I just explained, let me know, because that was my answer for you. Hopefully this is what you needed. Orlando Jose, to make micro one, we do the setup and the trading the standard contract charts. Yes, you could, nowadays you kind of could do both, because liquidity did pick up on the micros. So you could chart the micro and trade out of the micro. I would say 98% of the times the chart of the micro and the chart of the E-mini is going to be exactly the same. But what about that 2% times where it's different? And by the way, I'm improvising that figure, of course. But what about these rare cases where it's a bit different? Well, then my favorite way on how to do it would be to chart the E-mini contract and place the orders on the MES, like chart the at ES and place the orders using the MES. Okay, you can use activation rules for that. Okay, so buy the MES if the ES hits a certain value, so you can use activation rules for that. Easy to do. Very nice, Orlando. Very good question. Mark, suppose one had $30,000 accounts for options. On any day, what percentage of the accounts would it be conservative and or aggressive to have invested, and what percentage would one keep in cash? That's an impossible question to answer, Mark. That's a very, very relative. Any answer I give you is relative, and the reason why it's relative is because it's relative to the trader. Let's say you are trading with money that you don't need at all, so having all the money invested and go full size with maximum risk and run multiple trades in parallel would be adequate, because it's money you don't need. Now, let's say that it's very, very sensitive money. So then, you will need to be very, very careful. And what careful means is something you will need to define yourself when it comes to how many positions you want to run at the same time, how much risk per trade you admit. And this basically also will have an impact on how much margin you are utilizing at any moment in time. So it's very, very difficult. Okay, very difficult to answer as a question. The best answer I can give you, Mark, is to reverse engineer it. Okay, reverse engineer it. So get a methodology, back test it, get a decent collection of samples, get to know the expectation of those results, right? So let's say you back tested 100 trades and you came up with, with every 100 trades I make 50%. So now running one trade at a time. So now you reverse engineer that and you're like, okay, well, if I was to run two trades at the same time, I should make double. Do I have money to do that? Yes. am I okay to take this risk? What was my worst case drawdown? The worst case drawdown was to lose 5 times in a row. So if I do 2 trades at a time, I could see myself losing 10 times in a row. Can I accept that, or is too much? Maybe the answer is yes, I can accept, but with a third of the risk I used to take. So then what if you do that, right? And basically just keep playing with the figures until you understand, you find that sweet spot with what's the maximum I can make with the minimum amount of risk I want to take. Okay, and do I have money to do that, right? And if the answer is yes to all, you just go with it, and that would be your rule. Still, it's a bit relative because you are expecting that the future will be the same as the backtest, which is not going to be the case. But at least it's a reference, and then as time passes and you see your results, you can keep making changes and corrections to adapt the theory to the reality the most you can. But again, it's an impossible answer for me to give you as a black or white type of answer because it's just it has 100% to do with the trader in you, your need for money, how critical that money is, can you afford to lose it or not, and how much. And again, that depends on so many things. It could be age, it could be many other things, right? So again, it's I cannot answer that question. It's a very good question. But the best way I can answer is reverse engineer it. Okay, so backtest, get your samples, and reverse engineer. That's the best way in my mind. Yes, Mark, I'm just reading your comment. Your first question is not a simple one. I get you. Yeah, I agree. Yeah, it also depends on the probability of the trade, but really the probability of the trade, if you backtest a series of trades, and let's say you get 150, whatever, and you come up with a specific set of results, you get your expectancy, isn't it? And if you get your expectancy, this is going to help you to understand not only what is your average probability, but also what is your average reward to risk ratio. And again, getting that set of samples, I should say, and calculating your expectancy out of it is really going to help you to understand what you got in your hands, and you can reverse engineer and plan from there. But don't do it only based on probability, because also your rewards and your risks will have a lot to say. You may have a methodology with let's call it a poor probability, but a fantastic reward to risk ratio metric, and it's amazing. And vice versa. You may have a very high probability methodology with a very poor reward to risk ratio metric, and it's still good, right? So again, the best way to do it in my mind is to reverse engineer it, even if you do that, the answer is not going to be perfect, because then you assume the reality to be exactly as the theory, and it's not going to be like that. So you will want to do that as a first step, knowing that the following month, the following quarter, the following year, you're going to have to do adjustments to adapt to your reality, because trading real money is not the same as backtesting or even paper trading. It's not the same. Emotions are not the same. Putting on the side that market dynamics may change and the results may vary a bit. Again, earlier we talked about calculating an average and then a standard deviation. So, to get a range, instead of having a probability 60%, get a range is more useful. Anywhere between 57, 62, that kind of metrics is more useful. Okay, and then I would base my results based on the worst. So doing something like that would help you to get as close as possible when it comes to theory and reality, to get the two as close as possible, even though it will never be the same. Okay, very good. Very good. So it seems that I covered all the questions. Yeah, it seems that I did cover all the questions. So therefore, my friends, the session is over. That's it. We just concluded the session, and I will see you next time. Keep up the good work, everybody. You guys keep sending your emails, your questions. Keep up the good work. Keep practicing the methodologies and everything else. And of course, anything you need from us, you know where to find us. I'll write it on the screen in case you forgot. But basically, support at tradewithufos.com. Shoot an email to us. We'll be delighted to answer your questions, and I will see you next time. Thank you so much. Take care, everybody. Bye-bye.